welcome back. Welcome back. Y'all ready to learn? It's day 7. Welcome back to the Ascent. Alright. So, today we're talking about trends. I don't know if you could hear me over that music, but I hope y'all are excited because we are finally getting started, and I'm gonna actually be showing you guys how to do stuff. Now, don't get too excited, okay? Because I'm not gonna be showing you how to place trades yet, but we're getting started. And now that you are on TradingView and hopefully you've spent this last day, or if you're watching this in the future, at least 10 to 30 minutes just, absorbing TradingView, now we can actually get into showing you guys stuff and using those tools, and we can start going through the strategies. Now that you've been introduced to TradingView, what I use to actually look at candlestick charts and read price action, we can start showing you guys how to use it, how to start implementing things. But we have to start from the very beginning. Okay, so today we're talking about trends. Trends are a wonderful tool to just understand. It's not even a tool, it's just a thing markets do. I want you to be able to understand that markets don't just go up, they create trends, and the trends are what go up or go down. But in that trend, it can go up and down. Okay, so we'll get into it. We're going to talk about highs and lows. We're going to be talking about the 5 phases, and then we're going to be talking about a little bit of supply and demand. And then I also want to touch into FOMO, because now that we're getting started and now that you're looking at charts, I don't want you to start freaking out and then placing trades that you're going to lose because you think you missed out on something. So we'll cover some of that today too, because psychology is some of the biggest parts of trading, and having a grip on your psychology is going to get you further than anything else. Of course, you need more than just psychology. You need skill, you need discipline, you need so many things. But every video is essentially going to have a little bit of psychology dipped into it because it's so important. Okay, so also say hi to our buddy. This is our buddy back here. He's doing some very hard work for us. I don't know what he's working on. What are you working on? Cool. All right. So with that being said, let's pull up a chart. We're just going to find a spot, and we're going to identify a high and a low. Okay. All right. So what makes a high? A high is exactly what it sounds like. A high level in price. Okay. So when price action hits a peak and then it goes back down, that's a high. But we're gonna make it a little more defined. So if you were looking at these two candles and you wanted to discern your most recent high, because you're going into this price action here, and you say, well, what is the high? Is it this? Is it this? Is it this? Is it this? Well, it shouldn't be that complicated. Let's make it pretty simple. Where's the highest point of price in those two candles? Right there. Great. Problem solved. Now, if you were looking at these two, how do you think you would decide your high? Well, you wouldn't. There's no high yet. It hasn't gone back down. Now, if you were to go into the candle, maybe, because there's a wick, right? We know that wicks mean that price went to a price and came back down from it or up from it. If you have price and you think about what we know about candles and how they form, right? Price opened right here for this black candle, and then it went up and it created our high, and then it went down, created a low, right? And then it closed back up here. So what do we know? It went up again. From open, it went up at some point in this candle, okay? That means this is the high. Now, you still need the two different colors because, again, this is not a high. You might have thought when this candle formed that this is a high. No. It touched it again, made the same high. Doesn't count. Finally, red candle forms, and once it closes, it has to close. You have to wait for the candle to finish. Okay? Fucking jerk it off if you have to. Let it finish. And then it confirms that this is a high. Because if it was a blue candle, it's still not done. It still hasn't made the high yet. Okay. I think you get it. Same thing with lows, okay? This red candle is not the low. That's not the low. As you can see, the wick goes down past it. So what's the low? The low is this. But you gotta wait for this candle to finish forming, because if it was still red, that wouldn't count. Okay, now if we go into this candle, like if we were to zoom into the 5 minute or something, and if we zoom in from the 5 minute to the 1 minute, we can now see a little bit more accurately why we marked what we marked. Okay, as you see, this is not the low. Price went up, kept going down, went up, spiked, went down, and then created the low and closed and then started going up. That's why you have to wait for confirmation, and that's why you have to stick to the time frames that you're sticking to, because they will show different things. But when you're talking about highs and lows, if you can do it right by just picking the lowest low and the highest high for what you're trying to pick, like this right here is a high. Why? Because there's a blue candle and then a red candle, and it formed a higher high than its last high. Because this is also a high right there. When it opened, made a high, dropped down. This created a low, new high, right? This does not count as a high. Why? Because it's a blue candle and a blue candle. Doesn't count. Doesn't hit our criteria. Not to mention, this is the high. Therefore, it hit that high, didn't create the high. It tested it. Two different things. Awesome. Now, point out a couple more. Okay, so look at this one. Is this a low? I didn't hear any answers. All right, I'm just kidding. No, it is. It is a low, okay? The reason why is because this candle, this type of doji, where it's absolutely flat and shows no price action during close. See, you can zoom all the way in on it. The body doesn't get any bigger. That means price didn't change. That is a neutral candle. Okay, price didn't go anywhere. It's not red or blue. Obviously, if you look at the wicks, this one has a longer shadow on the top than the bottom, so there is higher selling pressure. If that makes sense, it went up this far and it came back down almost twice that. Okay, so that's why this counts as a red candle. It says blue, okay? Obviously it's blue, but there's no price action change. It counts as a red candle, okay? Because this might trip you up a little bit. Because if you were trying to trade this and you thought, oh, well, this doesn't fit our criteria, right? What if I mark this as a low and, well, technically you wanted me to count this as a low because that's the red candle. No, idiot. Okay, touched that, bounced off, made a move, and if you thought it was up here, you totally would have missed out, or even hit a stop loss and lost on a trade. We don't want that to happen, so we need to understand what are our lows. Okay, this is a low because this does not count as a blue candle. There was no price action. It did make shadows and wicks, but in the end, it ended up flat. That means it goes both ways. It can be a blue candle, it can be a red candle. It chose to color it a blue candle because if you look at all the other ones, they're blue. It's a consistency thing. You don't want to see one that's red, one that's blue, one that's orange, one that's green, when they're all the same thing. All it's telling you is there was an indifference. No change in price. If you read into them, you can start learning how the wicks apply pressure. And so that's why this one right over here is different than this one, because they apply different pressure. Okay, so I think we've got that out of the way. Obviously this is a low, this is a low, right? This is not your high. This is your high. Why? Do I even have to ask that? Because it's higher, okay? It's higher, right? This is a high. This one's pretty easy. Blue, red, high, easy. See, this is a low, right? Red candle, blue candle, went up, right? This is not. Why is this not? Huh? Well, this is a blue candle. This is a red candle. But this is an indifference candle too. So realistically, yeah, you could mark this and be like, damn, there's a lot of orders sitting at that price, but it's not your low. Doesn't fit the criteria, okay? I think we're pretty good on highs and lows, okay? So now I want to talk about phases. Like phases of trends, phases of markets. I want to talk about phases, okay? This is where it gets a little complicated for some beginners, but I think it's important to understand this in the beginning rather than find out about it later. Because if you can start implementing some of these more complicated things from the beginning, you're not waiting until the end to start implementing these things. Now, I do want to be very specific. Do not take trades on just one of these things that I teach you. Everything that I'm going to be teaching you has to be put together. So if you're watching my videos and you haven't watched anybody else's, you haven't learned my whole strategy to take a trade. So if you go take trades on what I've taught you so far, you might get lucky, maybe, but it's not enough to complete a trade. It's not everything I even use, okay? Most of the stuff we're talking about is basics and stuff that just like pops in my head as I'm looking at a chart. It's not things I actually have to think about consciously anymore. Like there are some things, when you use some tools, you got to consciously think about, where is it going? What is it doing? How do I apply it? When it comes to highs and lows, that is something that you just have to get used to seeing so naturally that it's click, boom, done. You got your highs and lows, done. Because it should be the easiest step to anything. It's finding highs and lows, finding the right highs and lows. Okay, and we haven't even discussed that. The right highs and lows depend on depends on how you're trying to trade. If you're trying to trade within the day and you grab highs and lows from the daily time frame, then you're going to be way off and you're not going to hit those highs or lows because what you're looking at is too zoomed out. If you're trying to make a trade within the day and you're trying to pick out highs and lows, you need to be looking at 1 hour and 4 hour time frames, maybe even 15-minute time frames. But if you're trying to make a trade over the course of an hour and you're looking at daily time frames, your high is going to be way off. Okay. You need to understand what highs and lows are accurate for what you're trying to do. If you're trying to trade off of a 4-hour time frame, then maybe daily highs and lows are best for you. But if you're trying to trade off of a 15-minute or a 5-minute time frame, using a weekly high is not going to get you anywhere because it'd take too long to even hit that high. It's not going to happen, right? Okay, so understanding that is important. We will get into it in a different video when we talk about volume and order flow and all that. But for now, I just want you to understand the basics of highs and lows. There are other ways to make more accurate predictions of highs and lows and where it'll retest and all that, but we're not there yet. And, it's going to take some time. So you got to take this step by step with me and learn each of these things one by one, the way I teach you. Phases. The phases of the Wyckoff method are built on the premise that the market reverses through a slow pattern most of the time, okay? Not all the time. Sometimes news comes out and it'll just, right? We saw that on Friday. But usually it will reverse over a course of patterns. Usually there's something it does before it reverses. And if you know what to look for, you can find those things and pick them out, and you can see, okay, it's gonna go down, it's gonna go up, whatever it is. We want to find out what's inside of this pattern so we can start to read it as it happens. Now, I want to emphasize on this one that there's a lot of patience involved in phase analysis, because just like anything else with trading, you do have to wait for it, right? You have to wait for it to finish to confirm, but it is extremely useful to understand where phases are trying to go and where the highest probability of phases going next is. Because if you can understand that just by looking at a chart, it's like, okay, this is in phase C. Okay, now it's about to trend. Okay, and then it's, well, after that trend, we'll ride the bot. We'll ride that last bit, whatever it is, however you put it together. But it's great to know these things, because once you can just look at a chart and be like, that's going up, it changes everything. Finding the highest probability is your job as a day trader. So to get right into it, phase A is essentially just the stop of the previous trend. Okay, it's important to be able to spot that so you can take out profits, or if you weren't in a trade, then it's just good to know where price is going. All right, anyways, phase A is just the stop of the previous trend. Now, there are different components of this. They're called logical events. The first one's called the preliminary stop, and then the second one's climax. The third one's reaction, and the fourth one's the secondary test. The preliminary stop, the first component of phase A, is just the first entrance of a large, well-informed group of traders against the main trend. So let's say it's going up, and then it hits 100,000 different traders take profits all at once. You would start to see it go down. Maybe not a whole lot, but you would see it stop, right? Trend, stop. That's all we want to see, right? That's the preliminary stop. Now, it can get more complicated than that. We can talk about distribution. So sometimes it'll stop slowly with high volume and it'll just kind of round out. Other times you'll see it create a large shadow or wick, and it'll go up, hit a price, straight back down, and close with a small body. But then it's got large amounts of volume, which I know we haven't talked about volume yet, but it just means the amount of trades that happen. Volume is the amount of trades that happen, and you can track that per candle too. So when you're looking at your candles, some of them will line up with your volume columns, and you can see one if it has a large shadow, right? And it comes back down, makes a small body, but the volume chart below it shows that candle has a ton of trades that happened. It shows you that there is a large supply that battles the demand of the trend, right? So there's a lot of traders that are selling off, that create supply, that battles out the demand that was creating the trend that was there before, right? If we're talking about an uptrend, it starts to push it down. Now, the climax is really just the highest high or the lowest low before it starts to, flatten out, kangaroo. The Wyckoff method labels it as distribution and accumulation, but I think that's a little much. We don't need to call it that, right? It's just consolidating. And the climax is usually marked by a wide range candle. So those big body candles that we were talking about from one of the last videos, but it's also got large amounts of volume. Okay. So it's not just, price tanked or price went way up, but there was like barely any trades. No, there's tons of trades and price moved a lot and didn't create a shadow or a wick. They're called wide range candles, big body candles, dicks. I don't care. I don't care what you call it. Okay. There's so many synonymous names for a lot of this stuff. So if I spit out something and you're like, oh, he said that before about this, is that the same thing? Yes. Just assume yes. Okay. Or watch more videos. The reaction, or the third part of phase A, is defined by a sharp movement in the opposite direction of the climax. Okay, so we see the climax, we see the big candle, and then we see it just reject. We see it bounce up, bounce down, whatever the trend was doing. We see it do the opposite and then just stay away. Call it a reaction. The reaction is seen as a confirmation of the climax. That way you know, okay, bottom or top is forming now. What's happening next, right? Then we have the secondary test, right? So we have the reaction. We have the big move coming down. I know I'm not drawing this out for you guys, but let's say we're in a downtrend. You have a big candle, lots of volume, right? And then it has a reaction. The secondary test is the last part of phase A, and that's when it comes down and it hits that last bottom that it made. Okay, we already know how to find lows. The reaction is up, created a low, creates another high, and then the test comes back down and it does the same thing and it reacts back off that price. That's phase A. A couple things about phase A. Phase A is not meant to help you find entries. Yes, we did just talk about how a trend will stop, but it's not the best place to find an entrance, especially for us who are going to be learning options. Okay, I'm going to be teaching you guys options trading. Just have to wait. Because if we can't be precise with an options trade, you'll lose money. We don't want to lose money. Okay, so you're not looking for opportunities to trade, to place an order. Okay, that's not what phase A is for. When you're using phase A, when you're looking at it and you see it, maybe something just hit phase A, it is not time to take a trade. It is time to just absorb and read the market and wait. Just watch what it does and absorb it. Okay, observe, understand what's happening, and confirm that it's actually phase A before you do anything. Now, it is a good spot to take profits out from another trend. If you were in the trend, if you were in a trade during the trend that's happening and you see it hit phase A and it hits that preliminary stop, climax, retest, right? If it does all four of those things, great, you can take out. If we're in an options trade, it's a great way to see when price is about to stop and slow down, whether it's even just for a little bit. It's a great place to take profits, right? Not a great place to take a trade, but it's a great place to take a profit. Because if you were in that trend, you now understand that that trend is over. Okay. And it means phase A is really just to point out that the market's transitioning from a trend to a range. It's going to start consolidating. It's going to start accumulating or distributing depending on the trend that it's exiting. Okay. So it's ranging. That's all we want to know. It's coming out of a trend and it's coming to a price that it's going to sit at for a little while. Maybe bounce around in, but it's going to sit at a price. Okay. Now it can only be established after the secondary test, because if it doesn't hit that test and actually react off of the secondary test and instead pass through, then it's not a phase A. You just have a fucking trend. Okay. Right. All right. Great. Now, phase B. Phase B is essentially the confirmation of phase A. Now, I know we just talked about the secondary test can confirm phase A. The thing is, we're not over. There are 5 phases to this. It is still on your screen. There are a couple ways to make sure that it's phase A before you move on to phase B. And that would be looking for signs of climatic volume, right? We talked about this. Lots of volume and a wide range candle on those big body candles, big black dicks. Okay. And then in the preliminary stop, this happens. You see large volume, large climax, and then it stops. And then you see a reaction off of that. Okay. The reaction isn't going to be the same as any of your normal little pullbacks that have happened in your trend so far. What you're going to see with this reaction event is a reaction. It's going to react. Okay. That's why I call it a rejection, because usually it looks like it rejects price. Okay. You'll see a big black candle going down and then it goes, poof, right? Creates a big wick. Sounds like a rejection to me. Reaction events, they will look different than your normal pullback. Okay. It'll move. I'm going to show you an example on a chart. We're looking for phase A. We're looking for the end of it. We want our preliminary stop, okay? That would be this. This would be after that preliminary support, but we're not going to be using support and supply zones, or support and resistance. We're not using support and resistance, okay? But this is the preliminary stop. Then this is our climax, right? You see the volume spiked. Same with this one. Climatic volume, right? Spiked. This is our wide range candle. See its big black, sorry, its big blue body. Right, so that's our buying climax because this is an uptrend going into a downtrend. So what do? We mark that, right? Then this is our reaction, pretty clear. That's a reaction. And then this is our automatic rally. This is our rally, okay? You can tell because it doesn't go anywhere. It's not going anywhere based on the trend, right? If it was based on the trend, it would be up here, right? This is definitely the reaction, right? And then this is your secondary test. This one even had a little breakout just to fuck with people. And it said, well, I'm going to fake you out. I'm going to spring right here. And I'm going to push down to the lower side. Right? It wasn't crazy. It wasn't crazy. But this is a break of trend. Trend is broken here. This is the trend. Right? You might think, oh, this is the whole thing. No. No, because that's a fucking curve. Trends don't curve, right? If we put a trend on this, that's the trend. Trend breaks right about there. We no longer have a trend because what did we have? We had our preliminary stop. Price stopped. It rejected this pretty fucking hard too. I mean, look at that shadow. Look at that wick it made. Came down, fought this price a little bit here, pushed up, created climatic volume, climax the buying, okay? And then we had our secondary test after our reaction. Price didn't like that, and it kept going down and destroyed this trend. Right? Okay? All right? Can do it here too. I mean, look at this. Preliminary stop, okay? There's our reaction, and then our secondary test, pushed past it a little bit. And see, this is invalid. This is invalid because it didn't go past this. It didn't make a downside. It actually created a low and then created a higher low. Therefore, this is still an uptrend. This is not. Because what did it do? It created a low, right? Created a high, then created a lower low. What does that mean? It's no longer an uptrend. It's like magic, guys. It's like fucking magic. Now, it is essentially the same for the downside, right? So here's our downtrend, right? Here's our preliminary stop. Here's our selling climax down here. It would actually be this one. Wide range candles only. Or usually. Let's not forget, it's usually. But it's the lowest low, right? And this is the lowest low that it creates. And then we get our reaction back up to the upside. And then it tests this preliminary stop, which now becomes support. Right? There's a lot of supply sitting above this. Push price back down. Here's our secondary test, right? And now we have our rally. That's all we're worried about. Now we have our rally. Then in the end, it went way past, just a little slowly. Right? Cool. Got it? All right. Now, phase B is a little complicated to get into without going through the entire Wyckoff method. So I'm just going to break it down into the simplest terms I can so we don't spend too long on this. But it's the construction of the cause. And within the Wyckoff method, cause and effect are essentially just supply and demand, right? But it's more psychology based than that. Anyways, all we want to know is phase B is composed by secondary test at both limits of the range. And the key element in phase B is time. Ideally, phase B should be longer than phase A, meaning the rally that we're watching is going to take longer than the stop that we just went through. The reason we do this is because we're trying to be precise, right? We want to be as accurate as we can be, and that means being patient and waiting for the right time to place our trades. If we wait for phase B to finish and it takes longer than phase A, then we just know that we're not going to enter the market too soon, because with options, they are time-based. And because this is time-based, it fits with our strategy. We are on a crunch. If we put in a trade and let's say you're stupid and want to put in on a daily expiration, great, but the move has to be fast. You can't just be in it and wait for a whole hour, because you'll simply lose your money on that decay. The decay will eat your trade away. So we need to be patient. We need to time it right? And that's what phase B is for. We have to be patient. Phase B is about being patient, letting it test and test and test, right? That's all it is. It's just a bunch of tests. We talked about secondary tests. That's all you're watching. Also, I mean, if you're just patient with phase B, it gives you a chance to watch for those fake breakouts. You don't want to be caught up in a fake out. It's going up, and then you're like, oh, hell yeah, let's get in the trade, because you're not patient. Well, the thing is, it was just another test, and you didn't know. Okay, it was just a fake out. It was just a spring, and actually it wants to go down to the downside. Now you're going to get stopped out, and you're going to lose some money. We don't want to do that. So just be patient. Wait for phase B to finish constructing. Within the method, it talks about accumulation and distribution, which is essentially just supply and demand, which is also just the cause that you see on your screen here that it's talking about. Okay, so when it's constructing the cause, it's trying to decide which way price is going to go. Is it building up supply? Is it building up demand? Because when it comes to these smart money traders, they will push price in certain directions and force essentially an imbalance where there's less resistance against their trade when they finally place it, right? So when you see price consolidating and it's just going up and down, likely it's some kind of hedge fund or some kind of smart money mover or some whale who has a ton of orders, but they want to fill it at one price. They don't want to fill it with market orders, because that'll make them lose money as it goes up. No, they want to fill it at one price, so they're going to keep pushing price to hit that until their orders fill without any resistance. Then it'll just go up after they put in their purchase. Now, there are two keys in this. We already talked about one. It's just the time, just waiting. It should be longer than phase A, right? Phase A, as we saw in those couple examples, it only lasts for like 10 or 15 candles, right? Phase B should be longer than that. At least 16 candles, right? If you're going to push it, at least let it be another 16 candles. Now, the other key is to be careful of your analysis on volume and price. Now, key 2 is to be careful of analysis of volume and price at both limits of the range. I didn't really show you in the example, but when it's ranging, when it's consolidating, right, you have to be pretty careful about what you pick as your highs and lows to define that range, because if you pick it to be too small, you might think there's more breakouts than there are, and you might enter in a trade that you don't want to enter in on. So using your volume and your highs and lows that we talked about to find that range is how you get your accuracy. You got to put it all together, and you got to be careful about it, because if you're not too careful, then you might end up just a little off, and you might enter in on a trade you don't want to be in. Okay, so it's only those two keys for phase B. Unlike phase A, there's 4. Phase B only has 2. Okay, and I'm sorry I'm not writing it out for you, but if you're listening, then you'll be fine. Take notes or something. Now, for a quick little example, we can use this one that we were just talking about, but we want to go over this real quick, because when we were looking at it, we use this area, right? Because this is the low. The thing is, the range is actually this. This is the range, right? And why is that? Why is this the range? Well, because this is our preliminary stop, but this is our original rejection of price, meaning this is where the range actually sits. This is just that order fill that fills out other orders and proves that this is phase A, right? once it comes back up in the price range, it genuinely just ranges for a long time. These are 5-minute candles. It ranges for almost a whole day. And then it breaks out, right? Now we are looking at ES1. These are futures. So this is like after hours starting at this point. These are not US market trades in this time zone, but this is still the range that we're talking about. This is still phase B. Because if you watch closely, it has a secondary test and then another secondary test. And then these are also tests. And then it has a fake out. Some people probably sold out their orders, did another, sold out more orders. Okay. And as those selling orders are bought up, there is less resistance to the upside. Therefore, we create this huge blue dick going towards the upside. Pretty simple. That's phase B. Now, we touched on it a little bit. Phase C is composed of a false breakout, right? So I think I've mentioned it in pretty much every video we've been looking at charts so far, but there's always someone trying to push the market to fill their orders at a certain price, right? And this is what we call a fake breakout. Price will look like it's trying to dash down or dash up to make a move that you're trying to trade. Little did you know, someone is manipulating that just to catch your order, so you have to sell it at a cheaper price. Then they pick up the order and ride the actual trend that was supposed to happen and not the manipulated breakout, right? So this fake out, as a lot of traders call it, this fake out is what composes phase C. Now, this is where well-informed traders will attempt to induce uninformed traders to go to the wrong side of the market, right? So that's just a better definition of what I just said, right? Pushing price, fill their orders, make you sell your order. It's a cutthroat world out there, dude. Cutthroat world. Now, the fake out's not a guarantee. Sometimes it's hard to tell when it's a fake out. That's why you just have to wait for the candle to close. So if we look at the top of this trend, when it's consolidating, it consolidates in this range here, right? And it does our little bounce. This is our phase B, right? All of this area is phase B. And then it comes down and it does this. Well, this is our fake out. This is our false breakout, right? It tricks all these uninformed traders into putting in shorts or selling out their shares. And in turn, the smart traders or the well-informed traders buy up those orders. Now there's no resistance. Now that they've sold all of these out, price can now push higher. And it does this. It does this, right? You think it's going to stay in this range. If you don't know what we're talking about here, you would have just thought, oh, it's going down to the downside. It's going to push down back to this low. Well, let's buy in and make all this money. No, because it finished. It finished consolidating and it wants to go higher, right? Even if it's not for a long time. This, from here to here, is still a good trade. Once it did the real breakout and it retested, if you bought back in somewhere in this breakout range, boom, easy money. Now on options, maybe you'd want this trade only, but you'd still make money on this, all of this. You'd still make money on all of that. You can find it again here. This is another breakout, but this is a bearish one. So what did we do? We consolidated in this range, right? Up, down, up, down, up, down. And then we had a large breakout to the upside. But this candle didn't finish forming when it broke out. When it finished forming, it was still in this range. So what is that? False breakout. What did it do? It forced all of these uninformed traders who bought in thinking it's going to go up to have to sell out somewhere in this range, meaning people who have money waiting to put into orders, who are smart with their orders, fill their orders that they just had to sell out of, and now price gets to go down, right? Cool. Awesome. Pretty simple. Now, phase D is when it finally breaks out, right? Not the fake out, but it finally breaks out and then it has a confirmation. So we did actually just show you this on, where'd it go? On this one right here. This is a perfect example of phase D. So phase C happened here, right? And then it pushes up, it breaks past this high, right? This is the breakout that phase D talks about. And then it has a confirmation, which is the second key of phase D. This confirms that this is a high demand zone and price will go up, right? Now, in the future, obviously, didn't hold up. But right here, that's all you need. Now, phase E is when it finally trends outside of the range, right? So we've had the breakout, we've had the retest. Now, this example is not great for it, but this is still a trend, right? This is still what we're looking for, right? This is our range. This is our breakout. This is phase D. Phase E is this. And then, I mean, even then, it starts right back over, right? So if this is phase E, then this is phase A, right back all over again, right from the start. This is phase A, right? But now we're going to the downside. So we accumulate. We have some weak signs of structure. We don't have a phase B for very long, but zoom in. Because we're talking about fractal patterns here. Fractal patterns mean it shows up inside time frames, inside other time frames, right? So now that we've zoomed in, we can see this better. This is a perfect example. I mean, look at this, right? Had our preliminary stop, blah, blah, blah. Test out, retest, whole phase B, right, is this area. And then we had our fake out. Awesome, cool. And then we broke past our high, and then we retested it. And there's our trend. And this would be phase E. And then you get to start it all over again. Phase A, right? Where do we consolidate to? Oh, well, this is actually a whole fucking trend. So this whole area is consolidation. Now, that's not one you would want to take a trade off of. But if you zoomed in farther, right? If we could go into like seconds and stuff, you could even find phase A in this, find phase B, find phase C, D, and then E, right? And then E goes all the way up here. Then you get your phase A again. Then you get your phase B. Then you have phase C. And then you have phase D, right? And then it tests right there. This is a high, right, people? Right? We got red candle, blue candle. It made a high. This is a high. This is your retest. This is your trend of phase E. Boom. Easy trade. Now, it's not the perfect way to trade. I just want you to understand market structure a bit better because all we're talking about is trends. We're not talking about how to place trades. But once you can understand trends better, you can start just looking at the market and being like, oh, it's at this point. All right, so now that we've gone through all of the phases, I hope I explained it well enough. If not, leave a comment below and I'll try to fix it in another video. But that was phases. Now we're going to talk about supply and demand just real quickly because I got to get out of here. And then we're going to touch on FOMO because I don't want you guys thinking you missed out on something when there's always new opportunities. So supply and demand essentially is just when there is demand for a stock and when there's supply for a stock. So let's say you want to buy into Apple, right? And Apple costs $150, but you don't want to pay $150. You want to pay $149, right? So you can put a limit order that says, hey, I'll buy this for $159 if you sell it to me for $159. Okay, so this is demand. I'm demanding for an order. Other side of it is your seller, the one who actually holds the Apple stock that you want to buy, might say, well, I don't want to sell it at 150, right? Because this is market price. No, I want to sell it at 151. That's what I want. That's what I'm asking for, right? I'm asking for 151 to sell it to you. This is supply. Let's say price is at 150, right? You have market orders that sit at the market price. Meaning if your seller wanted to sell it for market price, he could. It would pretty much instantly get filled. Now, he doesn't want to sell it for market price. So he has to wait for a trend to hit 151, right? This is where he sells it. Now, this means market orders looking for 151 buy price will fill this. That hits supply, right? When you're talking about businesses, when they are able to sell items, it's because they have supply of that item to sell you. It's the same thing for stocks. If someone doesn't have supply to sell you the stock, you're not going to be buying it. You're not going to be able to sell it. When you sell, you are pushing supply to the market. Okay? When you're buying, you're pushing demand. Right? 'Cause you're demanding, I want this. Right? When you're selling, hey, I'll give you this. Right? So supply is sell, downside. Demand is upside. Right? So when you're looking at a market and you've got a trend and it's doing this, right? What can you get from this information? There was sell orders that happened at this peak, sell orders happened at this peak, sell orders happened at this peak, and this peak, right? What does that tell you? There is supply sitting here, supply sitting here, supply sitting here, here, and here. Now, what else does this tell you? There is less supply sitting here than there is sitting at this spot, right? Because this spot has 3 different supply zones. If you were to chart this out, you would mark this whole zone as a supply zone. Be like, I know there are sell orders that sit in this area because it has happened in the past. People have sold, whether it's taking profits, whether it's losing money, whatever it is, there are selling orders that sit here. Okay. Now you can do this the other way for demand, right? So demand sits here, here, and here at these lows, right? So when you're looking at an uptrend, there is supply and demand zones. All 4 of these lows are demand, right? There's demand sitting underneath all of these lows. Now, how do you tell which ones have the most, right? Well, when a demand zone gets retested, right? We talked about retesting and tests. When a demand zone gets retested, there are more orders that get filled, meaning there is going to be less demand than there was here, right? There is just going to be less. There's more in this demand zone than there is after it gets retested. There's more demand sitting at both of these 2 prices than there are at this price, because this price is a retest of an old demand zone, filling more demand orders, right? This has never been retested, meaning there are more orders sitting in this demand zone. This one already had orders filled. So there are less orders sitting in this one. Now, supply in an uptrend is a little different, right? Because if this is supply, and this is supply, and this is supply, and this is supply, and this is supply, then this would actually be the weakest one, because this one's already been broken through. And sell orders already came back down, retested. They didn't like it. All these sell orders got pushed through. There's huge imbalance sitting from here to here where it broke out, right? There's imbalance there. There's imbalance on this price, right? Because there weren't enough sell orders. Now, why is this area stronger in supply? Well, because it came up here, it rejected, right? And then it came up, it rejected again, forcing more sell orders. And then buy orders, right? They're fighting and fighting, forcing price down because there's more sell orders than there are buy orders because they weakened out. It's the other way around when you talk about a downtrend, right? So we talked about demand, right? And it does its little consolidation thing. If this is our demand, and this is our demand, and these are our demand, this is going to be the strongest demand zone down here. Why? Because all the selling orders got stopped out and people were able to put in more buy orders, pushing price higher. And then, like we said with demand, these supply zones up here are going to be the strongest. So if price comes back up and it hits this supply zone right here, chances are it consolidates, right? Because there's a lot of selling orders that sit above this that were never touched. For this, buying orders started getting touched, selling orders started getting sold off, forcing price higher. I hope that made sense. Now I just want to talk about FOMO real quick because it's a pretty big deal. So if you were looking at the market, or if you are already a trader and you've been looking at the market, you were trading on Friday, and if you were anything like me, right, you placed a good trade in the morning, okay? So for my trade, I placed a short. My alert's still sitting there, actually. I placed a short with a stop loss above the high, and then I took profit right when it hit this, right when it peaked, okay, because I saw it do its little thing. Thought, no, I don't want to see it go back up there again, right? But I totally missed out. I mean, look at this, right? On an options contract, if I capitalize on a move that big, okay, this tells you, it says 1.83%, right? Well, it's different for options contracts because they have different things that affect their price. I would have made almost 1,000%, not just 30% that I did, right? Now, I could spend all day getting upset about this and then try and place more trades, being like, oh, I want to get in that move. The thing is, the move's over. That move happened. It's not going to move like that again in the same day. It just doesn't happen that way, right? And yeah, you could hop in on this trade, but this would be a terrible trade for an options contract. Maybe you can hop in on this because it moved fast enough, but throughout the day, you'd actually lose money on this. If it were an options contract and you bought in anywhere right here, yeah, thinking, oh yeah, I'm going to short it because it's just going to keep going down. Well, you were fucking wrong. It's important not to get caught up on those things because you can end up starting to put more trades in than you originally told yourself. You can start leaving your strategy because if your strategy is like mine, it's time-based and you shouldn't be taking trades after a certain time. Put it all together. I think that's it for today. I gotta get going. Love y'all. Thanks for watching this far. Damn, this was a long video. I've recorded for almost 2 hours. I wonder what it's going to edit out to. See y'all in the next one.